Hello and welcome to Assay TV. Today I have Ian Roper, General Manager of Shanghai Metals Markets, Singapore with me. Ian, thanks for joining us today.
Well, thanks for having me, Amy.
And we're going to talk a little bit about China's recovery and outlook for the metals. And so, Ian, I don't know if you want to kick us off, talk a little bit about the global, what do you see as the impact of the global recovery from COVID on the metals prices?
Yeah, sure. So I mean, for 2Q, we were very bullish across the board, really, that China's demand was going to come back strongly, with China stimulating and obviously kind of pent-up demand built through their extended New Year holiday. And that's certainly been happening, right? I mean, Chinese seem to have managed the virus very well. It's hardly there at all now, and life there is largely back to normal. So demand onshore has done very well. And the other side of the equation on the supply, at that stage, certainly early 2Q, we're seeing huge supply disruptions, especially places like Latin America, iron ore, copper, etc. Huge supply disruptions. So that's what made us very optimistic. Today, however, we're seeing more and more optimism about Western world recovery post-lockdown, and you're definitely seeing the demand coming through there. You're also seeing Chinese exports are recovering on the back of that, kind of destocking through Western world during the lockdown period. So everyone's now trying to get more goods, white goods, etc., out of China. So that's benefiting as well. But on the supply side, we're now in the recovery stage, right? We're no longer seeing the same degree of disruption that we were in the second quarter. Miners globally more used to dealing with the COVID issues, social distancing, how do we manage the mines, etc. They're on top of those issues now. So yes, some of them may be high grading, they may be not doing the full maintenance schedules, but by and large, the supply is increasing. When we look at iron ore, for example, iron ore supply globally, 1.5 billion ton market, supply was down about 250 million tons annualized in the second quarter. We've now seen 150, near 200 of that already switching back on. So that makes us very cautious about iron ore recovery. Equally in copper, Chile, Peru, no longer getting worse today. Supply will start increasing in the months ahead. So yes, globally, ex-China demand is certainly recovering, but slowly. Whereas the Chinese demand, that's been exceptional right through the middle of the year. So sequentially from here, we don't see Chinese demand getting much better than it already is. We're not bearish. We're not expecting Chinese demand to collapse. We're just saying it's already running at extremely elevated levels. We don't see it getting any better, especially as the more recent policy guidance has been along the lines of, China is happy with growth now. There's no need to do so much stimulus. If anything, the next steps would be more towards tightening here. So yes, with supply universally lifting across the board, both on the mining side, more recently, China domestically, we saw very strong smelter production, record highs for aluminium, strong increases for copper, zinc, nickel, etc. in our August data. So yes, supply is responding to the high prices, and that leads us to believe that price is perhaps now a little bit too elevated.
Okay. And talking a little bit more about China's recovery and stimulus, what has their stimulus really focused on so far, and where do you see that kind of moving as we kind of come out of the virus?
Yeah, so the growth came through extremely strongly in the second quarter, right? Construction activity, rebar production was hugely down through March, April, and then it was at record highs by May, right? So the execution on the stimulus was incredibly rapid, right? Our feedback from construction companies we were talking to by June was that they were running at 110% because there was that sense of urgency. Beijing was pressuring to get stuff done, throwing money at people, cheap credit, special bond issuance, etc. And property as well. Property developers were quite bullish. The property market bottomed out already in 3Q last year. So activity levels were very strong by then. But since then, that July the 30th, we had a Politburo meeting, and they came out after that with statements essentially saying loosening is finished, right? We are actually happy with growth. There is no longer a concerning unemployment problem. Growth's been stronger than expected. Therefore, we don't need to do so much kind of economic support, and we can go back to focusing on the traditional things like structural reforms, quality of growth rather than quantity, etc., etc. So that just makes us think, for the last few months of the year, Beijing's no longer got its foot flat on the accelerator here, and execution on stimulus was extremely quick in 2Q. It's not like we have much of a delay in China. So the fact they're backing off from that, we do expect, we are worried there's more downside risk to demand in the fourth quarter than upside from these elevated levels.
Okay, great. And I guess more in the long term, what do you see, what can you expect from China's next 5-year plan? What do you see kind of them coming out with?
Yeah, so the next 5-year plan, the discussions will start more detailed in October. So we'll start to see headlines coming out after that. Now, it's very clear a lot of the headlines could be interpreted bearishly, right? Obviously be cutting the GDP target, probably to something like 5.5% maybe, because the base is so much higher now. So that's just natural that they'd be cutting some of those headline targets. Our concern from a commodity perspective is that you may get bearish headlines around, core commodity sectors like rail budgets, grid budgets, some of that central infrastructure, because they've built so much of that. We've already seen this 5-year plan. China's essentially been stimulating since 2016. So we've actually beaten a lot of those targets for things like rail infrastructure. They were ahead of the 5-year plan 2020 target by 2019, right? So we do expect absolute cuts in the next 5-year plan versus the current 5-year plan for some of those central budgets. However, the flip side of that is that the way China's been operating, and we've seen that with this year's stimulus, is there is less central planning of a lot of this spending now. There is a lot more trust in the provinces. That's the upshot of the anti-corruption campaign. 10 years ago, Beijing's nervous to give too much money to the provinces because they're worried about corruption and things, whereas these days, there's a lot more trust in the local level execution. So therefore, Beijing is able to do things like they will issue the central bonds and everything, raise the financing centrally, and then just allocate the financing to the provinces. And we see the execution very much at a local level. So yes, urbanization is slowing. China has very poor demographic trends in the 2020s, but the local level infrastructure will very much continue. In our steel demand model, for example, subways overtook high-speed rail last year as the biggest steel consuming infrastructure. Because, building a subway, you build a rail at ground level, all you need is the steel in the rail track. Whereas the subways, obviously, you've got the big tunnels to support, you've got all the stations infrastructure as well. So they're hugely steel intensive, copper intensive as well. A lot of cables needed to power everything. And the way Chinese cities work, they don't just build one subway line at a time, they build an entire network. So that local infrastructure build out is still going to be very supportive for demand in the next 5 years.
Great. And maybe you want to talk a little bit about some of the key trends in metals, metals demand that you're foreseeing in China?
Yeah, so the metals demand absolutely has been very solid. The concern is that the expectations for demand, like for the back end of the year, are extremely affected. That's why we saw things like iron ore, steel prices doing very well, even though the markets don't look that tight. There's plentiful steel around in inventory, plentiful iron ore around in inventory, but people were willing to hold and pay higher prices because of that expectation demand will be better. So our main concern is that demand expectations are too high. We're not bearish on demand. We're not expecting a collapse in demand. We're just saying that demand is already so strong, we don't think sequentially it's going to get stronger than it is. Meanwhile, supply is clearly lifting across the board, and that just means we do worry prices will come lower. So you have seen more recently, last couple of weeks, we're in kind of early September now, open interest levels in a lot of the exchanges have come down, right? There has been some profit taking, but still, no one really selling anything or going aggressively short here. But that's certainly what I expect to see in the coming weeks.
Great. And the EV story has kind of come back strong in China as well. Are there specific policies that are coming out to push this, or what is kind of pushing that trend?
Yeah, so on EVs, we've been pushing a more bullish tone on EVs since the end of last year, because we said, look, 2019's been a terrible year, sales slowed dramatically, unwinding of a lot of the kind of battery-focused subsidies and everything in China. But the structural story is very strong, and we expected sales to do very well this year as those subsidies were kind of replaced with this new dual credit quota system. So Beijing was thinking, look, the subsidies were purely focused on battery technology. Whereas Beijing really wants the car companies to think more holistically about the whole vehicle. We want them to build a good quality EV that consumers want to buy. So therefore, they replaced the battery subsidies with essentially an obligation, a quota system where every car company must produce and a certain number of EVs each year, and obviously they'll raise that target every year. So that's why all the auto companies have so many new models coming out this year. So yes, obviously the sales kind of got pushed back with the virus disruption and everything in the second quarter, but sales are now gaining more traction. So yes, as well as the national level policies, you are seeing in China a lot of local city by city subsidies, cash subsidies for people buying EVs, tax rebates, etc. So that's helping as well, and more globally as well. I mean, especially Europe, you see a lot of subsidies coming through now, politicians everywhere wanting to push a green recovery story, etc. So certainly we get a lot more interest now in the EV materials space. It's very much the hot topic, starting to feel like second half 2017, if you remember the kind of bubble we had into and after LME week 2017, when everything was getting excited around that. And we have seen similar price moves in nickel again, right? Which, if you refer back to my presentation there, we just don't see the structural tightness in nickel, but the price is just moving up and up and up, partly due to this EV euphoria. So that's the problem. The sentiment is good, the sales are recovering, the news flow is very positive, but when we actually look at the underlying demand supply for the battery materials, we don't really see any fundamental tightness in any of them for this year, next year, even in 2022. There is plentiful supply. So yes, things like lithium and cobalt prices have been quite weak now last couple of years. We've seen a lot of supply closures. The problem is that supply is in the background. If prices were to rally strongly, supply would come back quickly. Equally, we still have supply growth in the pipeline next couple of years. So for 2021, 2022, we don't see really any of the battery materials in much of a deficit here. But the structural story from 2023 onwards, as the demand continues to increase, China's looking for a 25% EV penetration by 2025, 40% by 2030. We think that those targets are certainly achievable. So yes, the structural story is very good, but just that near term, next 1 to 2 years, we're not quite so optimistic that there'll be much price performance in the battery material space.
Okay, great. And so, I mean, certainly a lot to stay tuned for. And well, thank you, Ian, for joining us today on Assay TV.